You spent 5 hours a week researching stocks for the last 10 years, and you just got beaten by a guy who clicked buy once in 2014 and forgot his password. By the end of this video, you will know the exact mathematical reason why that lazy investor crushed you, and why picking individual stocks is a game designed for you to lose. But first, we have to expose a multi-million-dollar illusion. We are taught our whole lives that hard work pays off. Study more, get better grades, practice more, win the game. So naturally, we apply this logic to investing. We read earnings reports, we watch financial news, we try to find the needle in the haystack. But here is the brutal truth. Over a 15-year period, more than 90% of professional stock pickers failed to beat the market. These are guys in $1,000 suits with teams of PhDs who do this 80 hours a week, and they still lose to a boring, unmanaged list of 500 companies. If you do not believe me, let us look at the most famous bet in investing history. In 2008, Warren Buffett bet $1 million that a simple, low-cost S&P 500 index fund would outperform a group of top hedge fund managers over 10 years. The hedge fund managers had every resource imaginable: algorithms, insider analysts, supercomputers. The result? The index fund absolutely destroyed them. Warren Buffett won the $1 million. Why does this happen? Why does lazy beat smart? It comes down to two things: fees and survivorship. Let us talk fees first. When you buy a mutual fund or let a pro pick stocks for you, they charge a management fee, usually around 1%. 1% sounds like nothing, right? Let us say you invest $100,000 over 30 years, and you get an average 7% return. Without fees, you end up with around $760,000. Now, let us subtract that 1% fee. Your return drops to 6%. Your final total drops to $574,000. That tiny 1% fee just ate nearly $200,000 of your money. An index fund, by contrast, typically charges around 0.03%. It is virtually free. So what actually is an index fund? Instead of trying to find the best stock, you just buy a tiny piece of every stock. If you buy an S&P 500 index fund, you own a slice of the 500 biggest companies in America. If a company does badly, it gets booted out of the index, and a better company takes its place. The fund automatically upgrades itself. You do not have to do any research. When the economy grows, your money grows. Historically, the S&P 500 returns about 10% a year on average. That means your money doubles every 7 years, completely on autopilot. Now, I know what you are thinking. Why not just buy the index fund, but also buy some individual stocks to get rich faster? Because humans are terrible at timing the market, a massive study looked at what happened if you missed just the 10 best days in the stock market over a 20-year period. If you stayed invested the whole time, your $10,000 grew to around $70,000. But if you panicked, sold your stocks, and missed just those 10 best days, your final total drops to $32,000. You cut your money in half by trying to be smart, and here is the kicker. The best days in the market almost always happen right after the worst days. If you try to avoid the crash, you accidentally avoid the recovery. As millennials, we have lived through two massive crashes already: the 2008 housing crisis and the 2020 pandemic drop. We are naturally wired to be scared. We want to outsmart the system to protect ourselves, but the data is undeniable. Stock picking is a distraction. It drains your time, drains your money through fees, and statistically, it guarantees you will underperform. The boring strategy is the winning strategy. Buy the whole basket. Set up automatic contributions every single month. Let the compounding do the heavy lifting, and go spend your time living your life. If this was helpful, there's more on the channel.